All right, let's dive right in. Today we're going to tackle a really important topic in Canadian tax: how you can defer recapture. We're going to look at the ways you can postpone a pretty hefty tax bill when you get rid of a property, whether that happens by your own choice or because of something totally outside of your control. And before we get started, just a quick note that this presentation was prepared by Dr. Samir Al-Rishawani with some support from AI. So here's how we're going to break it all down. First, we'll get a handle on what recapture actually is. Then, we'll explore the two different ways you can defer it through involuntary and voluntary dispositions. After that, we'll walk through the nitty-gritty of the process itself, and we'll wrap up with a quick summary of the key rules. Okay, let's get started. Section 1, Understanding Recapture. This is really the core problem we're trying to solve whenever an asset is sold. So, first things first, what in the world is recapture? It's one of those tax terms that sounds a little technical, maybe even a bit intimidating. But trust me, the idea behind it is actually pretty simple. Okay, so think of it this way. When you own a business or a rental property, you get to claim a tax deduction each year called capital cost allowance, or CCA. It's basically the tax system's version of depreciation. Now, recapture is just the CRA's way of taking back those deductions as income if you end up selling the property for more than its depreciated tax value. It's like the government balancing the books. You got a tax break for all those years, and this just makes sure it's all squared up when you sell. And that brings us to the main goal here. From a tax planning perspective, the strategy isn't to make this tax disappear forever. That's not really on the table. The real objective is to defer recapture, to push that tax bill into the future. Which leads us perfectly into Section 2 and the first way you can actually do that. We're talking about involuntary dispositions, basically when something happens to your property that's completely out of your hands. Now, this is absolutely critical. The set of rules that you have to follow depends completely on why you got rid of the property. So the very first fork in the road is asking yourself, was it my choice or was it involuntary? We're talking about things like a fire, theft, or maybe the government expropriates your land for a new highway. Now, if you find yourself on this involuntary path, the rules are very specific about the property itself. To qualify for this deferral, we're talking about a rental property. That's the key. And here's the big condition you have to meet. Just losing the property isn't enough to get the deferral. You have to go out and buy a replacement property, and this is important. It has to be for a similar use. The good news is the government gives you a pretty decent amount of time to find that replacement. You get a full 24 months, that's 2 years, and that clock starts ticking at the end of the tax year when you lost the original property. So let's put it all together. You have an involuntary disposition of a rental property, and you replace it with a similar use property within that 2-year window. Boom, you've done it. You've successfully kicked that tax can down the road, and the recapture is officially deferred. Okay, on to Section 3. What if it was your choice? Let's talk about the second path, voluntary dispositions. Now, you can still get a deferral here, but the rules are definitely a bit tighter. So what if you just decide, you know what? I'm going to sell my property. That's a voluntary move, right? And because it's your choice, a whole different set of rules kicks in if you want to defer that recapture. And here's the first major difference. The type of property matters a lot. For a voluntary sale, it can't just be any rental property. It has to be what the CRA calls a former business property. In simple terms, that's a building you actually used to run a business. So as you can see, that's a much stricter definition. Now, one thing stays the same. Just like on the other path, the fundamental rule is that you still have to buy a replacement property. That part doesn't change. But, and this is probably the biggest difference of all, look at the timeline. It gets cut in half. For a voluntary disposition, you only get 12 months, just 1 year from the end of the tax year of the sale to go out and get that replacement. And this comparison really spells it out, doesn't it? For the involuntary path, you get 24 months, which makes sense. You need time to recover from something unexpected. But for the voluntary path, it's just 12 months. The logic is, hey, you planned the sale, so you should be able to plan the replacement pretty quickly too. And let's be crystal clear about what happens if you don't follow these rules. If you mess up, maybe you buy the wrong type of property or you miss that deadline, it doesn't matter which path you were on. The recapture is triggered immediately, and it becomes taxable income in the year you originally sold the property. Okay, so we've got the rules down, but what does this actually look like when you're filing your taxes? That brings us to section 4, where we'll walk through the actual process. This is where the rubber meets the road. Now, the way this process works might seem a little backwards at first, so listen closely. In the year you actually sell the property, you have to report the recapture on your tax return and you have to pay the tax on it. I know, it feels wrong, but you pay it up front. Then, once you've actually bought the replacement property, you go back and file an amended return for that original sale year. That's when you officially take the recapture off the table, and the CRA will send you a refund for the tax you paid. All right, we're almost there. Let's wrap things up in our final section with a quick summary, putting everything side by side so it's easy to see how it all fits together. This chart really lays it all out nice and clean. For an involuntary disposition, you're looking at a rental property, and you've got that generous 24-month window. For a voluntary one, it's got to be a former business property, and you're on a tight 12-month clock. But look at the bottom line. If you tick all the right boxes for your situation, the result is the same, a successful deferral of recapture. So when it all comes down to it, what's the main takeaway? It's that everything, and I mean everything, boils down to two key factors: the timeline you have to follow and the specific type of property involved. The rules are strict, and understanding them is the key to successful tax planning. So the big question you need to ask yourself is, which pathway applies to your situation?